Hello, everyone. My name is Patrick Zabala. I'm the Partner Alliance Officer for Arizona Central Credit Union. And we're going to be doing a Credit 101 Understanding Credit presentation here. We've got two branches here in town. We've got the one on West Street there, close to Coconino High School, and then we've got our Woodlands Village Boulevard branch. So let's get started here. A couple of the key points are going to be what is credit and kind of what's going to be important regarding it. The lesson here is to use credit responsibly, paying all bills on time, building that solid foundation over time and maintaining it. And throughout this course, our goal is to make sure you understand how to use credit to your advantage. It's a great tool as long as you ask, as long as you use it wisely. So you'll find great tips on how to use credit here and how to build a good credit history and what to do if you lose your credit as well to get it rebuilt. So let's get this started here. So credit is the ability to borrow money and get whether or not you're approved or denied for loans as well. It's a reputation system that lenders can use. So it's made up from information about your borrowing history, which is found in your credit report. So what I'm going to do is provide a participant workbook, and towards the bottom of that workbook is going to be a lot of links to, one of them is, for instance, annualcreditreport.com will be on there, and that way you can check your 3 credit reports for free once per year. And some other links will be on there as well that will be important because you're not able to get your credit score for free through that website. So if you want to get your score, then you'll need to use something like Credit Karma, or if you have a major credit card such as Capital One, American Express, or Discover, a lot of those are going to have free monitoring for actually checking your credit score. Also, if you use TurboTax, at the end of when you filed, there was a section that asked if you wanted to continue to your benefits. And one of the benefits on TurboTax is the free credit score as well. So you can always log back into TurboTax and access that as well. So the main reasons why you'll need credit in the first place is if you plan to take out loans for school, buy a house, or open a credit card. Pretty much anything that requires borrowing money, having good credit is going to be vital in that scenario. Long positive credit history makes you an attractive borrower, and it can open the doors to more financial opportunities in life, such as paying for college. Maybe you're pursuing higher education right now, or maybe you have children that someday you hope to send to college. The cost of college is rising faster than inflation, so it's unlikely that you'll be able to pay the entire bill. That would be the better scenario, because then you can avoid kind of the interest charges and things like that. But having a good credit will ensure that you'll either qualify for the student loans with the lowest rates, or even have more favorable terms. Maybe that it's worth it, instead of dumping your savings account, for instance, to pay for college. You could keep your maybe keep most of your savings account, pay off some of it, and get a loan for the rest. So it just gives you more options in general. And then, of course, buying a home. For a lot of people, homeownership is the cornerstone of the American dream. But without good credit, it's pretty tough to qualify for the mortgage. So the best mortgage interest rates and the most affordable loan terms are usually going to be for credit score 720 and up. But there are a lot of programs that start at 580, 600, or 620. So there's options. But once you get to kind of the below, I would say 560, 580, that's where we'll use some of the tips from this presentation to boost your credit up and to get above that number there. Even if you don't have plans to buy a house, credit is still great for finding a place to live. Most landlords these days require good credit in order to rent. Usually they're not necessarily looking at the score, they're looking at the report itself. They're checking for fraud, they're checking to see, do you have a lot of liabilities that maybe are unpaid right now, and that might lead you to misrent, for instance. So they're using this reputation system as a way to judge kind of how, who can rent from them, and to limit their risk, essentially, is what the landlord's doing. And then jobs, a lot of jobs these days are checking credit. Again, in from what I've seen, in general, they're not looking at the score. For instance, at the credit union, we're not looking at the score. We're looking for things like fraud on a credit report before we hire someone. If they're, behind on some payments and things like that, that's not gonna hurt them in terms of finding the job. But at some employers, it might. So that's another great reason to build up kind of a solid foundation. And the good thing is, even if you're missing a lot of payments and maybe that's hurting your score, a lot of these things reset. Like missed payments, for instance, reset after 2 years. So they go off of the report. And so we'll talk about that a little bit more in detail. And then of course, owning a credit card. One of the biggest reasons to establish a good credit is that you can take advantage of all the benefits that credit cards have to offer. It's best to try to keep credit cards at as zero balance or as close to zero as you can to avoid paying interest. But to be honest, these days, credit cards are pretty necessary in a lot of respects, because, for instance, renting a car, unless you're flying into the town, you can't actually rent a car with cash, check, or debit. You have to have a credit card to rent a car. If you're flying in, then I guess they assume that because you're pretty involved here, you paid for a flight and you had enough money for the flight, that they'll allow you to use your debit card to rent the car. That's in general from what I've seen, personal experience. But in any other scenario, I've never been able to use a debit card. So I do carry a credit card for that reason. Another thing is anywhere that's going to hold your money for an extended amount of time, such as a gas station or a hotel, I always use a credit card there, because I've had gas stations hold $120. I've had them hold 60. The usual is like 30 to 60. And what they'll do is you'll swipe for, let's say, $30 for gas. And then let's say they hold 60. So what they're doing is they're pending $90 out of your checking account for a certain amount of days until their merchant batches, right? Until their processing goes through. So you're out that 90, and it could mess with your budget. Like we discussed a lot of the budgeting things in the last presentation, and that could really affect it. But even more so than that would be something like hotel or transportation, like flights. The hotel, for instance, will generally hold exactly what you paid. So maybe I'm taking my family on a vacation, and maybe I need 2 rooms, and my hotel stay for 3 to 4 days ends up being like $1,000, right? If I use my debit card, that's going to be $2,000 out of my account temporarily until I check out. And they do that to make sure you didn't break anything, and they kind of charge you from that held money, is how they do that. So that would really like right now, I actually couldn't even do that, right? Because I try to keep my money in my savings account. So if I were to go up to a hotel and try to spend 1,000 and then they held 1,000, I'd be down to zero, right, in my checking account. So yeah, credit cards are pretty important there. And again, if you're paying that off as soon as it's due, or right away, whenever you want to pay it off, it'll still count as a payment, and you'll be at zero balance, and you won't be paying any interest on that. So for establishing credit, the best way to establish and build a good credit history is to lay a solid foundation and kind of have the right tools in place. So if you open a checking account at a credit union or bank, or wherever you're at, and then using it responsibly. A lot of us know some of this information, so this might be useful for sharing with our family members, or maybe getting somebody who doesn't have any credit built up, kind of getting them going. So that's why I'm covering some of the real basics here. And then, of course, not bouncing checks, applying for one and hopefully only one store or retail credit card can be good, because then you're dealing with a different company. So you're having kind of a more of a mix on your credit of different um, bills that you're keeping up. Or you can get a card from maybe a gas station, and then of course your credit union or bank card, and then only charge as much as you can afford to pay in full when the bill comes due each month. And then you can, if you pay in full and keep it at a zero balance, you'll be in the excellent category, which we'll talk about a little bit later. But that's essentially, if you're using 10% of your credit card limits or less, that's how you're maximizing your credit score the best that it could possibly be. Um, so, and then if you're having trouble with getting any of these cards, in this case, I absolutely suggest the Arizona Central Credit Union, because normally, I don't specifically suggest us, but in this case, we're just the best deal in town for secured credit cards and loans. The lowest interest rates, no annual fee, very low entry barrier to entry. So for the credit card, if you put down $330, we hold it in a savings account and we turn around and give you a $300 credit card, and you're automatically approved, and we don't even pull credit for that. And then for a secured loan, I believe it starts at 500. So if you put 500 down in a savings account, we give you $500 back to your checking account as a loan, and then you pay us back slowly over time. And you choose how long you want to pay us back. Say you want to do a 1-year loan or a 2-year loan. And in most cases, that option ends up being less than $20 to build up that credit in terms of the interest. And then, of course, the credit card is completely free as long as you are able to pay that off every month in full. So those two options are, especially if you combine the two options, if you are having trouble getting approved for things and you want to jumpstart your score very quickly, you can get a secure credit card with a secure loan. The minimum there would be like putting down $830. And then, of course, once these things are paid off, or once the card is converted, what you can do is you can apply to get your secure credit card converted to a regular card. Or if you end up closing it, of course, you get your money back that was held in the savings account. So that's how that works. And then those report on your credit report, just like how a loan or credit card would report. So that's why they build your score up so quickly. And then paying utilities and bills on time. This didn't used to matter at all, and it wasn't even tracked on credit. But recently, with the new versions that came out for how they calculate, they have added where if you don't have a score at all, which I would say about 10 to 15% of us don't believe in credit, don't have a score, pay everything in cash, and they don't want to, they see it as like a game that they don't want to play. They don't want to play the game, the credit game. And so I think the credit bureaus were seeing that a rather large percentage of Americans weren't engaging. So what they did was they made it so that even somebody that doesn't have credit can build a score and still use it if they need it. So for instance, they can see if you've overdrawn in your checking account. So the way that you use your checking account can affect your score in this case. They can see the utilities and bills paid on time. And then if you're late on your utilities, that's where it can really start to affect, because 30 days late means you have a late payment on your credit report for 2 years. So if you have perfect credit, it's going to be a devastating hit to have one late payment. If you have average credit, one late payment is not going to be as bad, especially if you have late payments already. Like let's say you have four different cards that are 30 days late within the past 2 years. So you've got 4 late payments. Adding a fifth, it's not a huge hit to the credit, but of course, it kind of resets that clock, that 2 years that you want to get out of those late payments, right? To have perfect credit. So that the late payments count like this: 30 days is late, then 60, then 90, then 120. And if you go to 120, you have 4 late payments with that product. So that's kind of how that works, just to give you an idea. And then having a mix of credit over time is really good. We already talked about why getting a secure credit card and a loan would jumpstart your credit. And the main reason is credit cards and lines of credit are revolving debt. That's what those are called. Loans, such as a secure loan or a mortgage or an auto loan, those are fixed credit. And those are the two sides of the credit coin: revolving debt and fixed. If you don't have at least one of both, your credit's not being built as well as it could be. You might have a really good score. Maybe you have one credit card, it's a 0 balance, and so you have a 700 score. And that's great, but when you go to apply for something, they're going to see that you have no history of a mix of credit, and so it's a little bit more risk even though your score is good. So just to give you an idea of what they're looking for there. And how do we find credit? There's different credit sources. The first step to finding it is make sure that it doesn't find you first. So I'm talking about waiting for applications to come in the mailbox. You definitely want to shop around. A really good website you can use is called nerdwallet.com. And that can really help you shop around for what you're looking for. It has everything broken down by section, and it's pretty easy to use. I did sign up for an account with them just because I started using them in all of my webinars and presentations around the state. And so I was like, all right, well, if I'm going to be I know a lot about them, but if I'm going to be talking about them a lot, I need to get an account. And it was a free account, and it also allows me to check my credit score. So it's one of those that I talked about earlier, like Credit Karma, for instance. And so it's been great because I know that if I need something, that I can make sure that I'm getting the right thing. So, and then of course there are all kinds. There's the depository institutions, which are banks and credit unions. There's the credit card companies. Insurance agents can pull credit. Automobile dealerships and pawn shops. So we're going to talk about the issues with things like pawn shops in a little bit here. But you definitely want to evaluate the fees that are going to be on each. For instance, on credit cards, a big fee to look for is the annual fee. And so I'll cover a breakdown of the different fees to look out for to make sure that you're getting the right thing that you need. Oh, so payday and installment loans. I want to talk about those, and that goes for pawn shops as well. The loans can carry really high interest rates and a very short payback schedule, like for instance, 3 months payback. And they have caps, interest rate caps, but the caps are very high, like 30%, 50. You know, I've seen loans that were over 100% just because of the fees that got wrapped in. And that was from a payday place. And then I saw a 60% one that was from a pawn shop. So those are definitely dangerous. So be on the lookout for that. And then rent to own furniture and appliances, it can cost significantly more, sometimes 2 or 3 times more than buying the product outright. But just make sure to read the contract, because if the contract states, let's say, that you get a full year to pay it back at 0%, and there's no back pay, for instance, like, oh, if you don't pay it until the 13th month, we're going to charge you interest for the entire time that you are at 0% interest. So you want to avoid that kind of thing that's in the contract. So there are some rent to own that I've found that were good, and then there are others that are really bad, and they kind of, I don't know, I don't want to say that they're trying to hide the fine print, but it looked hidden to me. So so credit reports. All right, it's going to have your information, current loans, old or paid off loans, and then usually past 7 years, how much you've borrowed and your monthly payments. It'll have your payment history, any late payments, and if you're always on time, as well as any defaulted loans which are in collections, and public records like bankruptcy and foreclosure. So bankruptcy and foreclosure ones will stay on the credit report for 7 to 10 years, usually 10. And then after that, they actually end up falling off, which means that you can actually recover from public records like bankruptcy and foreclosure, because generally within the first 2 years that you've had that, you'll be automatically declined for any kind of lending. But after the 2-year period, you're on like a revision basis, where usually the person just has to ask their manager to underwrite or take it up top, that kind of thing. So realistically, generally the longest it takes to recover from that is 5 years. Once you're out of the 5-year period, even though it's on your report, generally places will not even look at it. And then of course, after 10 years, it's not even there anymore. So, and then lenders look at your credit score, and that's usually for the interest rate. So the credit score affects the rate that you're going to pay. It doesn't necessarily get you approved or declined, but the score can always help you be approved, because what they're looking at is debt ratio. So the debt ratio is your income divided by your monthly expenses that show up on your credit report, plus your rent. So if you have a mortgage, that's going to show up on your credit report, and they'll look at that. If you rent, they're going to ask you to disclose your rent amount, and then you tell them how much you pay in rent, and then they'll add that in as a bill. And so they won't be looking at cell phone, life insurance, auto insurance. They won't be looking at any of that, because that's not going to be showing up on your report, and they won't even ask you about it. So what will show up are credit cards, only the minimum payment. They're only going to take minimum payments into account. So even if you overpay your mortgage, they're going to take the minimum you can pay on every product and then divide that by your income. And that's generally how you're approved. So if you have a very low credit score, but you don't have that much debt, your debt ratio is low, you'll probably be approved for a lot of products, for anything that you might need. If you have a very high credit score, perfect credit, and you have a very high debt ratio, you're going to be declined for anything you might need, right? And so that's kind of how that works. Is a lot of times it's the debt ratio, and sometimes the lender will tell you, like, hey, let's work this out, and if maybe we're able to pay this off, or if you're able to pay this off, and your debt ratio will go down now, so then we can get this loan going. So that's how that looks. All right, so the credit score. So this is the pie chart that is how your score is actually built. This isn't going to be perfect, and none of them are, including using Credit Karma or NerdWallet or any of that, right? because the three major credit bureaus have proprietary algorithms that they don't disclose to the general public. So this is just what they've given us to go off of. And so I just wanted to let you know. So there is a little bit of mystery there, but I really like this pie chart, and following this chart, I've been able to do great with my family's credit, and just kind of helping them. So the biggest part, do you pay your bills on time? This doesn't mean, oh, I was 10 days late, or I was 15 days late. That actually doesn't matter at all. What matters is, well, other than the late fee, watch out for those. I got to be careful when I'm talking about that kind of thing. But yeah, so watch out for those late fees. But when it really matters is when you're 30 days late or more and your lender reports it, which usually they have the duty to report it at about the 30-day mark, but sometimes they'll kind of hold off, and give you like a day or two. But anyway, it gets reported after 30, and then 60, and then 90, and then 120. And then usually it'll go into some sort of collection effort at that point, or maybe they'll start calling you over and over. Usually that happens around the past 30 to 60-day mark. And so once you get either a 30 or a 60, that will be, you did not pay your bill on time. And so for the next 2 years, you'll have a late payment on your credit score. So, and that's 35%. So we talked about it a little bit earlier. It affects you more if you have perfect credit. And then if you already have some late payments, adding another one isn't as big of a hit, but you have to get to that 2 years with no late payments. That's the key. So the next one is amounts owed. This is 30%. In my head, I think this is more like 40. Because this is, in my opinion, the most important. And this is the way that you can actually maximize your credit score almost immediately. So the way this works is, all it is, it's a percentage of how much you're using of all of your revolving credit, such as credit cards, lines of credit, home equity lines of credit, anything that's revolving where you have this minimum payment, and then you can pay more. And then if you charge more, it revolves, right? It's a revolving, kind of a flexible, adjustable rate type situation. So you add up all of your limits. Let's say you have 2 credit cards that are $500. So you have $1,000 in limits. That's all of you have in limits, right? And then you owe $250 total among the 2 cards. That means you have a 25% usage percentage. So what you're doing there is you're really helping your score because you're below 30%. Being below 30% usage is kind of the key. And if you can get below 10%, or if you can get to 0, in terms of your credit score, there's not much difference at all, if any, between 10% usage and 0. So, but if you can get there, then you're in the excellent category. If you're at 30% or less on your limits, you're in the great category. And then once you get to 30 to 50, that's where it starts hurting your score, above 30. And then above 50, it hurts it more. And, above 60, 70, 80. And at like 80, it just crushes your score. It's like a 100-point drop from my personal experience. I've personally been where my cards were nearly maxed out at one point when I was in college, and I saw what it did to my score. And then I saw it with my family. And when we were able to get those paid down, their score went back up 100 point. Like it went up to near perfect. And so this is the way that you can really improve your score, especially if you want to kind of game it where, okay, I need to get a car. I want to get the best rate and the best term on this loan. So what do you need to do? You need to pay down your cards as much as you can if you can afford it. Definitely don't dip into your emergency fund or your savings. Never want to do that. But if you can afford it, pay down the cards as much as you can, and then wait, say 20 days for your credit report to update, and you'll see a huge difference in your score. Your score will shoot up if you do that. And it only takes 20 days, whereas a lot of things with credit take 1 to 5 years. Like history can take 2 to 5 years to really get built, and then more if you're looking for the perfect scores. So a lot of things are in the years, and this is in the less than a month you can improve your score. So that's what I really like about this one being so fluid. Then length of your credit history, 0 to 6 months is no credit in terms of length of how long you've had a credit product. This does not count checking accounts, and it does not count bills or anything. It has to be a credit product for this one. So that's 15%. And then once you're 6 months to 2 years, you're new to credit. Once you're 2 years to 5 years, you've got the average history, and then 5 to 10 and beyond. And I believe the excellent range is like 20 years or older. So that's why it's actually very difficult, if not impossible, for somebody who's young to have a perfect score, because they don't have this bucket, and this bucket is 15%. So, and then 10%, are you adding debt? So this is actually, this isn't worded great, but this is from the official source. So they're talking about inquiries and new credit. So how many inquiries do you have in the past 2 years? You may have heard the term inquiry be referred to as a hard hit on your credit, or a hard pull. And that's when you go to seek out credit and you apply, which means the company is pulling your credit for the purpose of what you want. So what that's going to do is it's going to put an inquiry on your credit for 2 years. And that inquiry can lower your score depending on how many you have. And what their rationalization is here is that it can look like a bit of a risk if, say, you have 30 inquiries. So if you've gone to 30 different places in the past 2 years looking for credit, there might be, maybe there's some fraud going on. Maybe somebody has your identity, or, there's just risk factors. So that's why but this is a kind of a smaller bucket. It's just 10%. But again, if you want to really maximize your score, don't apply for anything for 2 years past the date that you got your inquiry, and that'll be another 10% that will be feeding into your score. And you can check your inquiries on annualcreditreport.com, and it'll tell you the dates and everything like that. One thing to note is that if you are applying for a exact credit product at multiple financial institutions, such as maybe you're trying to get a mortgage, and to be honest, you probably don't want to go with the first lender you try, unless the terms and rates are looking really favorable. Then that's fine, but you might want to shop around, maybe apply for 3 different mortgages and see which one charges you less. Those, if done within a shorter time frame, 20 days or less, then those will actually count as 1 inquiry. Even though you'll see 4, for instance, on your report, they'll only count as 1 for this bucket. Same goes for auto loans, the famous applying at the dealership. Okay, people a lot of times freak out because what the dealership's going to do is they're going to shop around to see where they can get you the best rate, because it depends on the kind of car it is, how many miles are on it, what kind of term or payment you're looking for. There's a lot of factors that go in. So they have, let's say, 15 different companies that they partner with. And hey, they just pulled your credit 15 times, right? 1 at each. Well, luckily, I'm here to announce that that also counts as one inquiry. So that's not actually all that bad um, at all. So yeah, that's just one inquiry. And the final one, do you have a healthy mix of credit, which we talked about earlier? A healthy mix would look like 2 credit cards, an auto loan, and maybe like a secure loan or a personal loan. Or it could be a mortgage, 1 credit card, and an auto loan. Again, the mortgage is going to be big. It shows that you're juggling a lot there with the mortgage, so that feeds into this bucket a lot more than the others. But multiple credit cards can help, because if you, let's say you only have 1 credit card with a $500 limit, and on that card, we'll use the last example, you owe $250. Well, you're at a 50% usage, which means your score is being reduced. So if you were to add another card, let's say another $500 card, but you still owed the same on that 1 card that you had for 250, you now have 1,000 in limits with 250 owed, which means you have a 25% usage, and that's going to boost your score a lot. So that's where it can be beneficial. Don't get multiple cards if you're going to spend on them and not pay them off, because credit cards are some of the highest interest rate products. It's basically payday loan, pawn shop below them, and then probably credit card is right there below them, which is a lot lower than those two. But so yeah, they're among the highest interest rate. Luckily, at the credit union, that's where I have my card. The rates are half the national average, and up to half the Arizona average as well. So I can, it's a little bit easier if I do need to spend, finance something on the card. It's a little easier to do just because the rate is not very high on it. Like I have a card that's 24.5%, which is with another company, and then the one at the credit union is 10.9 annual percentage rate, just to give you an idea. So you'll need a total credit score of 740 or higher to get the best interest rates. Some places have switched to 760 or higher, but usually 740 or higher is going to be the key. So no, you actually don't need that 800 score. Everybody always talks about the 800 scores. But so let's go here to avoiding debt. So don't pay. Okay, so this is going to change a little bit because of the times that we're in. I'm going to add a lot of information throughout this regarding the coronavirus, the times that we're in here. And so usually not paying only the minimum payment is good. We'll talk about the minimum payment trap. However, I have actually switched. For the next 3 months, I will be only making minimum payment right now, just because I've got a plan where I want to add to my emergency fund, to my savings account that we talked about in the last presentation. And I feel comfortable doing, let's say, 3 to 6 months of minimum payments so that I can add to that emergency fund, not so that I could take that extra money and spend it on random stuff, right? That wouldn't be good. But so that I can add to that savings account to give myself a buffer in case anything happens throughout this crisis, like maybe if my heater or AC blow out or something, things like that. So yeah, that's what I'm doing. And then don't charge more than 25% of your credit limit. Not only will that save you on interest, that will also save you on your credit score. And then obviously don't charge up to your available limit or higher. Using one card to pay off another can be tricky, the balance transfer cards. The only thing I would say about that is if the same pattern is going to persist on the new card that was happening on the old one, it's better to just do a consolidation loan, which might be higher interest because obviously the balance transfer would be 0% for 6 months or 12 months or whatever it is. So the consolidation loan might be a little bit higher interest, but you'll actually end up saving money because it's a fixed loan that will end. It has a finish date on it, which is great. That's why I love those loans. And right now, I would be personally comfortable with doing a balance transfer card. 5 years ago, before I started working for the credit union, I would not have been. I would have done the balance transfer and I would have just done the same thing. And I would have exited that 12-month period with a huge balance still. And now I'd be paying, 20+%, which is the average, national average. So yeah, that's just kind of one of those things that you have to think about. And so for credit cards, we're just going to talk about a couple of things to watch out for. So this fee is very rare, but if you see a fee for if you always pay your credit card in full, that one's horrible. I would stay away from that card at all costs. I haven't seen it in a while, but I know they exist. The way it works is normally if you pay your card in full, it's free. There's no interest, but this kind of fee will charge you like $1 or $5 if you are always paying your card in full. So pretty rare, but yeah, just look out for that. Rate increases are tough. The most common rate increase is if you make a late payment, which generally credit cards don't have a grace period for whether you're late or not. So the day after the payment's due, you're usually late on a credit card. And so if you see that the card has rate increases for being late, that's usually not a good sign. Late payment fees are common. Every card has those, but just be on the lookout. If you see like a $50 late payment fee, not a good idea. I'm going to sneeze, so I'm going to mute for a second. All right, sorry about that. So over the limit fee can be pretty common. And then look for the grace period. It's always useful to know if it has a grace period or not. So let's get to losing the card. So if you do lose your card, call the card issuer, call the credit union or bank that issued the card. The toll-free number should be on the back of the card, which I would either write down and have at home where you're not taking it with you in your wallet, the phone number, or you can always just Google, pull up their website and contact information. So, and then it's usually a good idea to leave a few cards at home, not kind of always travel, because if you lose your wallet, then you'll lose all your cards, of course. And if you should try to call immediately if you can, because if you call, if you call within a certain time period, then your liability is zero. So your bank or credit union can refund the money, but otherwise the liability can be up to $50 per card. And then, so if you have 10 cards in your wallet and each one is used and you don't call right away, usually it's a 2-day period, or it can be, 2-day period for them to get your money back quickly. And then it's a 30-day period because not everyone has online banking, so they need to give time for people to check their statement to know that their card's been stolen, things like that. So, but yeah, if you had 10 cards stolen and you didn't report it, then that could be up to $500 in liability cost. So taking on debt. I'm actually going to switch to a slide here that covers a couple of things. But a lot of people think that it's necessary to become deep in debt in order to build credit, which is actually not true. Part of this comes from the fact that some people think that you have to owe money on a credit card to build credit. But actually, if you had, say, 2 credit cards and you use them maybe twice a year, let's say, and you pay them off in full. So in January, you use them on some bubble gum or whatever it is, and then you pay it off in full, and then you don't use them again until January comes back around. So the month that you paid them off in full, it's going to show that you made a $2 payment for your gum, and then the next month it's going to show that you made a $0 payment, but you still made a payment and you're still current, so you're still building credit. Same goes for the following 11 months. You have made a $0 payment, you're still current, you're still active, and you've made a payment. So you can build credit by not doing anything. You just get a couple cards and do nothing. Hopefully they don't have annual fees so that you're not paying for nothing. And you can build credit that way. That's actually what I did with my brother. And he's got like a 730 score, and we've never even done anything. He's just got his 2 cards, never uses them, except for when usually once a year, because cards can go inactive, and generally you'll get either a letter in the mail or a phone call stating that your card is about to close, or that it has closed. And what you can do is just call them and say, hey, I don't want my card to close. I wanted to stay open, and they'll just keep it open. So, but yeah, the easier way is just to use each card at least once a year, and that will at least keep them open. And so, yeah, that's the good thing. You're not going to build an amazing history by doing that, right? Because you haven't done anything. You just have these 0 balances, but you will build a good score, and you will build a good history. It's just not going to be excellent. It'll be good. Like my brother's score is in the great category. So just as an example. So yeah, it's not true that you need to get deep into debt. So let me switch this here. I'm going to try to share my screen on the participant workbook. So this workbook, it has this section here, 10 warning signs of too much debt. The biggest ones are going to be only making if your budget only allows you to make the minimum payments on your credit cards each month. We're not talking about, putting money in savings. We're talking about it's stretched that thin. Then that's a warning sign that you should not take on more debt unless it's like a consolidation where you're closing things down. And then having at least one card that is near or over the credit limit can be a warning sign. So be on the lookout for that. And then not knowing how much debt you have, just like we did in the budgeting presentation, I would say one of the action plans for this presentation would be to make a list of the debt you have and the interest rates that are attached to that. And that can actually really help you maybe figure out, oh, maybe I need to do a consolidation loan or a balance transfer, or maybe oh my gosh, my mortgage is 6% interest. That's crazy. The rates are in the 3s right now. Things like that can pop up and save you tens of thousands of dollars. Essentially, on the mortgage, it's in the it's in the 10,000 area of savings. On a car loan, it's kind of in like the 1,000, and then on credit cards, it can be in the multi-hundreds to thousands in savings. So, and then continuing to make purchases on a card while you're trying to pay them off. That can be really tricky. One trick that I like to use, because rental cars and hotels and things can only be used on credit cards usually, or sorry, rental cars can only be used on credit cards. That's my fault. When I do that on a card, if I owe on that and I'm trying to pay that card down, I'll immediately make a payment of the amount that I rented the car for. That way it's as if I didn't use the card for that purpose, so that I can still continue to pay down my card. Because if you have a card that's $1,000 and you owe $500 and you make a $25 payment, but then you charge, let's say $30 to it, you've done nothing to the payment, to the principal, right? So you're in an infinite debt cycle that'll never end, because you're charging to a card that you're trying to pay off. So that's just an example of that one. So let me switch back to the presentation, since you will be getting this this workbook. And if we scroll down, let me scroll down to the bottom here. There is a resource section right here, online resources, that's incredible. It has the annualcreditreport.com, the Credit Karma link, and then a couple of blogs and things like that. So I will be emailing that over to Katie. All right, so what to do if you can't pay your bills. So the worst thing to do is just ignoring the creditors, because a lot of times they can actually help with, if you make a good faith effort to call them before they call you, just make sure before you call them, know what you can afford to pay, given all your other obligations. So go through your budget that we created in the last one, and then kind of give them a number. And it could be a low number, you know. I've been in medical debt before where I was paying like $20 or $30 a month. And at first they said, "Can you pay more?" And I told them no, and they agreed. They accepted it. So I've been in that situation before. And if the discussions break down, which let me tell you, they can break down. Okay, so a lot of the the debt collector, they get paid kind of like by how much money they can bring into the company from people. So they'll usually like kind of they're strapped for time, and they want to get through as many calls as they can. So sometimes it can break down. And so I would just say immediately just call the Consumer Credit Counseling Service, which is the CCCS. And the number is there on your screen. And they can intervene with creditors on your behalf. But be aware that the CCCS may require that you cut up all or most of your credit cards. So we'll talk about closing cards. I get this question a lot, and this is a little different because it's pre-recorded, and so, but I'm going to try to answer some of the FAQ type things that I've had in previous presentations. Closing cards. So if they're newer cards, it actually won't affect your score that much. If they're your oldest card, it'll crush your score, because what it'll do is it'll reduce the average length of credit history that you have. Let's say you have a length of credit history that's 10 years old, and your credit card is 10 years old, and the next product you opened was 5 years later. So the second most oldest product that you have on your credit is 5 years old. Your credit will now shrink to a 5-year history after that card falls off, which is, well, it can take a while to fall off, but 7 years. But yeah, it can really hurt your score because it'll shrink your average length of history. So that's why closing older cards can be really not a good idea. In terms of newer cards, the times that closing a newer card can really hurt your score. Let's say you have 2 credit cards, one is 10 years old, one is 6 months old, and you find out that the newer one has an annual fee. Well, it might be a good idea to close that, but let's say the balances are $500 each on those cards. If your limits are, if your limits are 500 each on the card, so you have 1,000 in limits, and you owe $500 on the older card, that means you're at a 50% usage. When you close the newer card, it will immediately cut your limit down to 500 because you only have one card left, right? And there's no waiting period for that. That's on the next report that you close that card. So your limits will not be 500. Well, if you owe 500, you're at 100% of your limits. Your score is going to go down like over 100 points, right? So those are the only real things that you need to worry about with closing cards is how is this going to affect my usage percentage and how is it going to affect my length of credit? Because if it doesn't affect either, absolutely, you can close a card with little to no hit on your credit. So, and watch out for enticing ads for credit repair, like the ones you see on TV. If they promise to restore your good credit or get marks off of your credit report for a fee, usually like 500 or more, don't bite, don't go for it. Everything they do legally to help you, you can do for yourself for free, especially with the CCCS and annualcreditreport.com, and then using like a score website. And then if you can't pay your bills, don't add new debt. So stop charging on your credit cards, start using your debit cards. And then you can do either a consolidation loan if you are worried about wrapping credit card debt into another card for balance transfer, for instance. And then consider closing some of the cards if you don't like them, even if it might be a bit of a hit on the score. If you're having issues with them, it's not worth the headache and the drama just because, oh, my score might, because your score will come back. So it's just a personal choice at that point. And then the online resources. So what I want to talk about is annualcreditreport.com. It was a government website, which I wish it would have been called .gov because the .com kind of trips people up. But it was a program where every U.S. Person can check their credit report at Equifax, TransUnion, and Experian, the three major bureaus, for free once per year. And what you can do is you can either break it up where maybe you check your Equifax in quarter 1, your TransUnion in quarter 2, and your Experian in quarter 3 of the year. Or you just check it all at once, maybe January, you're checking all 3 of your reports, and then you're waiting until the next year to do it again for free. So the reason why you still need a credit score, one like Credit Karma, NerdWallet, TurboTax, Capital One, any of those, is because this annualcreditreport.com, it doesn't give you access to your score. The score is $10 to $15 per bureau. And you don't want to pay that because, you can get it for free. So that's the great thing about this website is you get your full report, including all the names that have ever been reported. You can defend yourself from identity theft using these websites and look out for like weird addresses that you don't recognize. You can report issues fully online or over the phone or through the mail. They still have the mailing way as well. And annualcreditreport.com is actually very, very useful, even though you don't get your scores. It's very useful for everything else. So, all right, so we're going to cover some tips here during the coronavirus. I guess I kind of covered some of these, but signing up for a free credit monitoring service to confirm updates to your credit are correct, that's really good. Even though you can only use the annual credit report website once per year, you can use something like NerdWallet or Credit Karma year-round. You can kind of log in there and see how things have changed. And then review the score and report on a regular basis to make sure that it stays high or is improving. And a lot of the services will give you tips like, hey, your usage percentage went up this month. This is how you can get your score up if you bring that usage percentage down, for instance. And then monitor your rates to find better savings. So that's going to be the main takeaway of this is hopefully what you can do is sign up for annualcreditreport.com if you haven't, and then a credit score monitoring place. Maybe it's through your Capital One credit card if you have that, or maybe it's through like American Express or Discover. And if you check that every once in a while, it'll give you tips on how to improve it. Um, and then it can also help you defend against identity theft, especially if you don't have like a monitoring service already. But even if you do, I like to be a detective sometimes. You could become your own credit detective and see kind of what the history is, what names have been reported using your social, what employers, addresses, things like that. And you can even call your identity theft monitoring place and say, hey, I found this stuff, and give them information to even help them to help you, right? So I'm going to give you these resources here with the slides that I'll email over to Katie. And I can't click on them here just because, this is pre-recorded, but it's going to have all of these employment, meals, food banks, and unemployment, all of these resources here that could be useful maybe for your family or your friends. I know all of you are employed and things like that right now. So, but I just wanted to give you that while we're in it together here during this coronavirus. And I wanted to put this slide in here to let you know that right now our branch lobbies are currently closed except for on appointment basis. So you can call and make an appointment to open an account or get a loan or whatever you might need. But other than that, our drive-throughs are open for any kind of deposit, withdrawal, transfer. We've also got our online banking, our mobile app, bill pay, all of that's free. And you can open an account or anything you need to online as well by hitting the join and then the join now. Just make sure that when it asks how you're going to get into the credit union, that you say that you're with one of the partners and list your employer. Just type in your employer's name, and then it'll make it an easier process for you. And I wanted to add our social media here. So that is the end of the presentation. The biggest thing that I'd like to urge you to take away from this is start monitoring your credit score and then your report. And if you can make a list of your debts and interest rates, it may allow you to figure out if maybe there's a better option on some of those, and that will lead to a lot of savings, which could turn into more fuel for your savings account and your emergency fund. So that's why this presentation really does tie into the last one, because a lot of this can save you a ton of money, especially if we're talking larger loans like mortgages, because the difference between a 5% and a 4 is huge over that 30-year span. So, but yeah, that this is the presentation. Feel free to email me or give me a call with any kind of questions. I am working from home right now, so my cell phone is wide open. So I really appreciate everybody's time though, and I hope you have a great day.